All right, investors. In this video, let me show you how you can find best stocks for 2025. Stocks with promising growth potential, stocks with good fundamentals. We will go through the stock screening process. Then I will tell you what things you should pay attention to. Then we calculate the stock target price based on our model. And based on analyst estimations, we will see the stock target prices, also extract their target prices. And then I'll show you when you should buy this stock and what should be your selling points. So this would be the complete comprehensive video. Unfortunately, we will not be able to analyze all the stocks, so I will pick just one stock to show you as an example. So let us start. Well, first, I'm a financial engineer and also a developer. I develop financial apps. I like technology. That's why I decided to start with the technology sector. But for you, if you see some potential in other sectors, you can also analyze them. But I think that AI is developing very fast, data centers are developing very fast, software applications developing very fast. That's why I decided to start with the technology sector. And that's how you should find your stocks, or you can simply go to GPT and ask ChatGPT what are the best sectors to invest in 2025. It will give you the list of sectors to invest in. Then with this list of sectors, you can use the stock screener. For our analysis, we will need the Google Sheets and Financial Modeling Prep add-on, how to connect them together. I will put the link to the description, and also I will put the link to separate videos. We will be using a lot of Google Sheets files, models, and to build all of those models separately, you can go to the description to this video and see all the links to my separate YouTube videos where I explain how to build those models. So let us start. First thing I'm gonna do, I'm gonna use the stock screener, and I'm gonna be using financial modeling prep endpoints. As you can see in the search, I'm using the formula equals FMP stock screener. Here I put 1000 just to fetch 1000 records, just to extract 1000 tickers. The exchange I'm selecting is NASDAQ. You can see as an example, you can take multiple exchanges, for example, NICE, NASDAQ, Amex, Euronext, and so forth. The country I'm choosing, the United States, the stocks that are listed in the United States. Then the sector, I'm choosing the technology sector, as I have mentioned previously. And again, for the hints, you can see what are the available sectors over here. Then this field industry, I'm leaving it blank because I identified the technology sector. Then the market cap above, I'm putting more than 1 billion to filter stocks on the mid cap and the larger cap. So I'm not taking smaller cap because they're usually more volatile. Then these things I am skipping. And one means the beta. Beta shows the risk of your stock comparing to the market. In our case, the market is index S&P 500 because we are focused on the US exchange, and the beta of 1 means that the stock is less risky than the market. So for example, the beta 2 means that the stock is 2 times more volatile than the market. Then other fields, I'm leaving them blank, and here is actively trading. I'm putting true to filter the stocks that are actively trading. I've already prepared the sheet over here. These are the stocks that I'm not going to consider because they had low PEG ratio. So simply once when you have this screener, it will extract you 100 tickers over here. For example, I put Microsoft share over here in my table. You can just input the stock ticker, for example, Microsoft. As you can see, now it's loading the data. As you can see, it is showing the EPS growth rate. Let's just correct it 15 over here and 60 divided by F60. So as you can see, EPS growth in the past 5 years is 400%, which is above 15. That's what we need. We should search for stocks with higher EPS growth rate. So our beta for Microsoft is 0.90, which is good. And then the market cap, it's a large market cap share, and the PEG ratio is very high, which means that the stock is overvalued right now. We're not considering the Microsoft share, and that's how I did these calculations. For extracting the PEG ratio, the formula is given over here. I'm using the FMP. Again, there is a separate video. I'm not explaining it in detail right now. Again, you can look on the description for the separate video on how to build this table. But the PEG ratio for Microsoft is very high. And similarly, I did for all of those stocks. That's a manual job. I've spent around 1 hour filtering all those stocks. And after doing that, I found the DocuSign that's with the stock ticker Doku, also the technology sector. When we input the stock ticker over here, let me input it here. Well, the financial modeling prep is extracting data for you. You should correct the table a little bit so it's F14 over here. I'm just calculating the percentage difference. And then we have, let's take the positive number of 40 over here, F40. We have amazing earnings per share growth rate in the past 5 years. It's above 50%, of course. And now we have the price earnings ratio, which is in line with the industry average. And we have a PEG ratio of 0.2114, which means that the stock is overvalued based on the PEG ratio, and investors expect stock grade upside in the nearest term, probably in the midterm, within maybe 1, maybe 2 years, because we're analyzing for the past year. So in this corridor, the stock should have very good growth potential based on the PEG ratio. So we made our first step. We found great stock DocuSign. So now let's get to the second step. The second step, we will be calculating the Doku's WACC to ROIC ratio. Again, this is very simple. So the ROIC trailing 12 months, ROIC is the return on invested capital. In the simple terms, it is showing your return on your capital, and the WACC is the weighted average cost of capital. That's basically your cost, the cost that company is paying to support its debt and support its equity. In our case, the cost is 8.34%, and the return on invested capital is 40%, which is higher than the company's cost. So then we divide the return on invested capital on weighted average cost of capital, and we get the ratio of 4.87, which means that the Doku is very efficient in its capital utilization. It is showing very good return on invested capital, much higher than the average peer return of, it is showing 4.87%. As you can see, the formula for fetching this is FMP Advanced DCF. I'm fetching the weighted average cost of capital from the DCF model from FMP. I'm inputting this formula to the Google Sheets, and then for extracting weighted average cost of capital, for extracting return on invested capital ROIC, I'm using another formula equals FMP K metrics TTM, which is trailing 12 months. Fresh data, A2 is the stock ticker DocuSign, and then I skip those parameters limit and period and just put the header F5. The header is the ROIC TTM. It's exactly how you should name it. If you don't name it, it will extract you all the key metrics. But for this video, we don't need all the key metrics. We just need the ROIC trailing 12 months ratio, and it's showing 40, which means that Doku is using its capital very efficiently based on this ratio. The next step would be to see how other investment analysts rate the company, and for this we will be using equals FMP price target A2. A2 is the stock ticker for DocuSign, and we are seeing how other investment analysts calculating the stock target price. As you can see, the adjusted target price is around 60. If we take the last adjusted target prices, it's been actually a while. The analysts didn't reconsider the target price, so maybe soon they will publish the new target price. And you can see the average number based on all the analysts is about 68, which is slightly lower than the current DocuSign target price. So the next step would be to calculate the stock target price based on our own valuation model. It's the price income model or the multiplicators model, or some analysts may call it financial ratios model, you name it. The aim of this model is to take the financial ratios of your company and compare it to the industry peers, to the average ratio of competitors. Again, I have the separate video on how to build this Google Sheet, how to use those formula, and I also have an article. I will put the link to the description. I simply input the stock ticker and then financial modeling prep fetching all the data from here, and I put the selected data, for example, price to free cash flow ratio. There is a formula. I'm putting it from here. It is 20.88, and I'm extracting this data to here. I'm so sorry. Z5, Z6. So I just make this 6. Yes, it is extracting this ratio exactly from here. Then I take the industry, not the industry, but I take the number for closest peers. These are 4 closest peers. Again, I was using financial modeling prep peer API endpoint. I will put the link to the description, where you can just input it into the browser, get your custom API key, install it, put it here, and then you can extract the closest DocuSign peers. Or you can just ask ChatGPT, what are the closest DocuSign peers? Just show me the ticker. It will show you ticker of the companies, of the closest peers. Just input 4 of them in the model, and then financial modeling prep will extract the data. It's FMP key metrics, and then it takes the stock ticker and extracts all the key metrics for the companies. Then you basically take the average number. For example, I'm using the formula here for net income per share. I'm taking the average formula. Again, you can see the formula over here. Where is this formula? We should find this formula M, net income per share. So I'm taking 4 closest peers and use the average formula, and after that it is calculating me the average data. Same I do for all the other financial ratios. For example, return on invested capital, the DocuSign has 0.40, and the average among closest peers is -7%. So Docu has greater return on invested capital. This is very important. Then I assigned equal weight. Since we have 10 stocks, I assigned 10% weight for each stock. The sum of all those weights should be equal to 1 or 100%. Then there is a simple formula. I divide the company's ratio to the average ratio and multiply it by the weight. And I get this coefficient. Then I multiply all of those coefficients to get the sum of coefficients. The next step would be to extract the current share price. Again, I'm using the formula FMP real-time price and then take the stock ticker. And real-time stock price is 94.52. And I multiply this number by a coefficient and I get the stock target price of 58, which means that the stock has 39% decline potential based on the price income model. I'm not using the DCF valuation model right now. Why, I will explain you a little bit later in the last section of our video. And as you can see, this target price 58, it aligns with the target price that we extracted among different analysts. As you can see, the last target price was initiated by this investment analyst, and he calculated the stock target price around 60, and we have a stock target price of 58, which means that the Doku is overvalued based on the DCF model, but it is undervalued based on the PEG ratio that we saw. So ideally, the stock that you're looking for should have a PEG ratio lower. Ideally, it should be between 0.3 and 0.8. That's the ideal scenario. And then it should have a gross potential of higher than 15%. Based on your model, it should be higher than 15%. So this would be perfect ideal case, and you should spend a lot of time, probably a few days, maybe a week, searching for stocks from different sectors until you come up with a list of 8/10 stocks. Why 8-10 stocks? Because it would be better diversification. If you take 3 stocks, it would be bad diversification, but 8-10 stocks, it's an optimal number. If you take more stocks, it would be difficult to undertake fundamental analysis every quarter, because you need to see how data changed, and you need to also change your assumptions depending on the actual financials that the company is posting. So the next step would be to make a vertical and horizontal analysis. I also have a separate video of how to build these Google Sheets for examining the vertical analysis and also what it means. And I have a special separate article. I can put the link on the description to the article and also to the video of how to undertake this vertical analysis. But the vertical analysis compares the number based on the base model. For example, it is comparing how the items like costs or gross profit change based on the revenue. So here it is 100%. First thing I notice on the vertical analysis is that DocuSign has very good gross margin. You should compare it with the closest peers. Again, over here we have closest peers. Take all those 4 and compare, take the vertical analysis of just input the stock ticker over here of each peer one by one to see the gross profit. If DocuSign has the highest gross profit based on the peers, that's a good sign. Another thing worth noting is that DocuSign has very stable gross margin. It means that the management is controlling its direct costs very efficiently. You should also see those numbers, and if you see huge fluctuations, then you should go to the financial statements and read auditor's report on what was causing these fluctuations. But on the income statement side, everything is good. I like how the income statement looks, and the balance sheet, everything also more or less stable. Important numbers like a cash. If you see cash increasing very rapidly, it's also bad because it's operational risk. So we should seek for more or less stable numbers here. You should also pay attention to debt. Company should have lower debt, or if you see debt skyrocketing, that also can be a bad sign for a company. As you can see, based on the recent data, if we analyze the company debt, the long-term debt is declining. It used to be 40%, but now it is, based on the last yearly data, it's 8%. That's good. That is decreasing the debt burden. That's a good sign for investors that you should also look for. On the liability side, everything is also stable and also looks good. Well, on the cash flow statement, I've highlighted few things that we should pay attention to. As I've mentioned previously, you should note that you shouldn't see huge fluctuations, and in this case we see some of the fluctuations. For example, we see stock-based compensation. That's a huge fluctuations over here. That's not necessarily the good sign. If you see the stable numbers, again, it's good. But in this case, we see large fluctuations like 106%, 178% for some years, and still stock-based compensation is high. It means that the management is paying the employees with their stocks more. And also you see the net income differential. As you can see how it's calculated, we're taking the net income and then we divide it by the net cash provided by operating activities. So what is a net cash provided by operating activities? Net cash provided by operating activities is the cash from the main company's business. If you don't see huge fluctuations here in this formula, it means that the company is generating its cash mainly from its main activities, which is a good sign. But in this case, we see large fluctuations like 108, minus 82, minus 13. It means that the company mainly is not generating its cash from its main activities, but it is recalculations based on the stock-based compensations. That's why it's high. That's why it is showing higher operating income. If you see, for example, we see net cash provided by operating activities. That's a high number over here. But this money is not coming from the main company's business because actual net income was negative for that given year. This comes from the recalculations based on the stock-based compensations for the company. And then we have this purchase of investments. That means that the company is investing a lot into something. That's usually not bad. That's normal for smaller companies. That's usually good for the technology sector companies. But this number should not fluctuate greatly. If those numbers are fluctuating greatly, as well as the working capital, then it would be very difficult to calculate the free cash flow. The free cash flow would be very volatile, and you won't be able to calculate it accurately, to forecast it accurately. And if you are not able to forecast it accurately, that means that you are not able to use the DCF model, valuation model, to calculate the stock target price. Because if the variance would be, if the difference between actual data and your calculations is too high, then you won't be able to forecast properly, and your target price would be higher or lower than the actual readings. And when the company posts its actual free cash flow data, then you would need to correct your model, and the accuracy of your valuation would not be very high. That's why you need this vertical analysis. Then on the horizontal analysis side, you just see how each item changed from year to year. We see a good numbers, and you should pay attention to revenue growth rate. You should pay attention to the cost. The cost should be declining from year to year or stay the same. That would mean that the management is controlling its cost efficiently. The next step would be to use the iOS application called Stocks to Buy. Let me use that application. It is showing the great time to buy stocks based on fundamental analysis and also intraday. If you're interested in trading the stock intraday, for example, open the Stocks to Buy app, go to stock type ticker, input the stock ticker, in our case Doku, press the analyze button, and now it is showing you that it's a growth type stock, and the best time to buy the stock is on the booming market. So this app shows you when is the best time to buy the stock based on Piotrowski score, stock's growth potential, dividend yield, and 3 and 6 months return. Since the stock has good 6 and 3 months return of 85 and 67% respectively, then the app says that it's a growth stock. It's good when the market is booming, when the stocks are rising, when you see the aggressive rise in the stock, that would be the good time to buy this share. Then the Piotrowski score is weak, actually, if it's around 8 or 9, and if the growth potential is above 15, that it would be value stock. It would be good for holding it in a mid-term, but in our case, Doku would be good for maybe a shorter term within the 1 year, because it has lower growth potential. It has a potential for decline based on fundamentals, but it has a good 3 and 6 months return. So it means that the shorter term investors are valuing the stock more, and it means that it's a good time to buy this stock on the booming market. Dividend yield, it's not showing. That's why it's not a good stock to buy on flat market, because usually the stock with a higher dividend, higher than 4 or 5%, are good on the flat market. Then you go to main screen, input the stock ticker, and it shows you, it is analyzing the stock sentiment, which is 0.5, the stock positive or negative mentions. If the stock has a lot of positive mentions on the social media, then it's showing you higher sentiment, for example, 0.6 or 0.7. That means that the majority of people, 70%, are mentioning it in a positive key than a negative key. But here it's like a 50-50, no positive mention, no a lot of negative mentions. And actually the equity rating is how analysts rate this stock. In this case, it's a neutral. They are rating it as a neutral, and at the EPS surprise, it shows that the company reported actual earnings better than analysts expected on the last reporting period. That's a good number that shows that the DocuSign is showing the great number on the EPS surprise. And based on the stock sentiment, equity rating, and EPS surprise, the Stocks to Buy recommends to buy the stock. It's usually sell, hold, or buy. In our case, it recommends the stock to buy based on these 3 ratios and the growth potential, but the growth potential is negative. That's why the equity rating is neutral right now. So the stock is good for the shorter term within 1 year. Then you can go to the candle analysis screen, input the stock ticker over here, and see if it's a good time to buy based on the candlestick patterns, and it will show you different candle patterns, and this sign means that it's a good time to buy right now, and this one means that it's indifferent whether it will go upwards or downwards. Just input the stock ticker here, press the refresh button, and see the detected patterns, and pay attention to this sign. If it's upwards, then it's a good time to buy now. If it's downwards, then it's a good time to sell now. This graph updates every 5 minutes, so it would be good for intraday traders. So if you're trading the stock intraday, buying and selling within 1 day, holding very short position, quick positions, then this candle analyst screen inside the stock to buy is your must use tool. But if you're interested in holding this stock for a mid-term or within 1 year, then you should use the stock type screen or the main screen to see if it's a good time to buy the stock. So based on the stocks to buy, the stock is a good idea within the 1 year, but only for a booming market. If the market will be expanding and rising faster, it looks definitely better than its closest peers, but it has the negative growth potential based on our custom model and based on the analyst assumptions, as you can see over here. But the good sign is that Doku looks better than its closest peers based on the financials, and also it has great PEG ratio. So if it's a good opportunity, we can buy the stock, but strictly for a shorter term. It's not a value stock, it's a growth stock that stock to buy application indicates us. The other thing would be to look for the points where you should sell the stock. Just input the stock ticker. We need the Chrome browser to use the Safari extension. As you can see, stock went upwards recently and now it's declining. So download the extension called Stock Analyzer. I will put the link to this extension in the description. Then input your custom API key, which you obtained from the financial modeling prep. Here, get your custom API key. You can press this button if you want to. And then input the stock ticker. Then press the calculate button. And you can see, as you can see, this is the stock target price calculated using the DCF model with conservative assumptions. Then the stock current price is 94, but we're not looking at this right now because we have already calculated it and we saw the stock target price. We are interested in the stop loss and take profit level. So let's say if you bought at the current level, you should sell at the 120.45 with profit, and if its stock starts declining, you shouldn't hold it below 77.33. It would be your stop loss level. It is calculated using the standard deviation, so it adds 2 standard deviation to the current price to calculate the stop loss and adds 3 standard deviation historical standard deviation, historical stock volatility to the closing price to get the take profit level. So this is how you can come up to the stop loss and take profit level, your trading range if you are holding this stock short term. And of course, you can use the candle analyst screen over here to understand when is the good time to sell and buy stock intraday, and use these patterns inside the application. So this is how you can analyze the Doku sign. It is definitely interesting stock because fundamentally it looks good, but still has a decline potential based on the DCF valuation model because of the negative cash flow and because it's difficult to forecast the free cash flow. So you should pay attention to the cash flow statement, maybe to the next reporting period. If the company reports better cash flow, it would be a great time to buy the stock. And actually, if the company reports better than expected free cash flow, then we can see the huge upside here, similar as we saw over here on this graph. So you should pay attention to it. And if you analyze the stock historically, it was trading much higher. So in perspective, if the company will improve its free cash flow, it can go much higher than it's right now. So now it's on the bottom, and it can be great opportunity to buy this share. If you want to try, just buy a smaller portion and then monitor the free cash flow. If it will get better, then it will result in the positive stock price movement. But of course, you should find 7-8 stocks more for your portfolio and use the Markowitz model to understand how to distribute the stock weights into your portfolio more efficiently. Again, I have a link to the separate article on how to build an efficient portfolio, to put the stock weights in your portfolio in such a way as to maximize your return and minimize the risk. I put the article to the description and you will be able to read it. Using this method, just find 6-7 more stocks from different industries and you will be good to go. That's how you can build your best stocks for 2025. Just don't forget to make your separate research and always remember that investing in stocks is about buying a company, not about the price levels right now and not about the forecasts. So first you should love the company, understand what they do. The company should have strong management, and then you go to the financial analysis, proceed with financial analysis and monitor your data regularly. That's how you should do the analysis. And I hope my video was helpful. Please subscribe, hit the like button if you enjoyed watching this video. Thank you very much for watching.